Good afternoon, everybody, and welcome to our Think Learning webinar, Top 3 ASX Stocks Under 30 cents. My name is Carl Capolingua. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we check out three very prospective small capitalisation stocks on the Australian market. After we talk about the Think Markets difference, of course, which is substantial $8 flat rate trades, your own holder identification number, unlimited phone support, and no hidden platform or subscription fees for fantastic reasons why your next ASX share trade should be with Think Markets. And if you are new to the Think Markets family and you'd like to get trading before June 30, we also have 5 free trades. There are some terms and conditions, as there typically is with these sorts of things, so head to the website for further details. Okay, the agenda for today is to check out 3 prospective stocks under 30 cents. We'll talk about the selection process and then get into the 3 that we've got for us today. The first one is Bannerman Resources, ticker code BMN. The next one is a very interesting little technology play called Houston We Have, an odd name. And then Tombadore Iron, TI1 is the final one. Okay, first we'll talk about what is risk money. And it's quite a pertinent topic to discuss when we are discussing stocks under 30 cents on the ASX, because we do delve into some very interesting territory in terms of the viability of companies. Now, these are very small companies. Typically, they are not making money. Many of them have no path to doing so. There are over 2,600 stocks listed on the ASX. Over half of them probably fall into this category. So it's worth discussing. If we do find something we like, how much capital might we want to apply to it? And this concept of risk money really is a very small portion of our total portfolio allocation, that if we wake up tomorrow and one of the companies quite literally wasn't there anymore, it got delisted, we wouldn't be too fussed. We wouldn't be happy about it, of course, but it wouldn't have a massive impact on our overall portfolio. The goal here is to allocate very small amounts of capital with the desire that it grows very large. So let's say this risk money part of our portfolio might only be 2, 3, maybe it's as much as 5%. But the hope is that over time, we might see multiples of 10, 20 times that return, and therefore, they can become large parts of our portfolio. If they don't, our downside is the small allocation that we've had. Hopefully you get the message on that one. Just reiterating, the stocks we're going to cover today do not have clearly defined regular revenue streams. Probably the middle one actually probably doesn't fit into that category. I think I wrote this particular slide before I selected the stocks, basically covering myself. They're not yet profitable, and that is a tick for all 3 stocks we're going to look at, but there does appear to be a clear path to becoming so. They are small capitalisation. In some cases, the trading of the shares on the exchange is quite sporadic, and that equals increased volatility, and volatility is a proxy for risk when it comes to investing. So we will do our best to look at the fundamentals of each of these stocks. Some of the information, as you would expect in this space, is quite scant. There's not a lot of financial information out there, and they're not widely covered in the broking and research community. So we'll do our best to decipher the information that companies have provided us. And then on top of that, we'll layer a technical analysis approach as well, where we will try to determine whether the market is seeing what we see. So, we can see only the best in the fundamentals. We then need to go to the market and see if other investors have found those positive attributes, or are they focusing on some things that we haven't missed. Maybe the real story is not as positive as we thought. So we do want to confirm that the price is in a strong short-term uptrend. It's also in a long-term uptrend, or at least that long-term uptrend is about to change. If it is also in a short-term uptrend, is the price also near an opportune entry point as well? And putting together those 2 layers, the fundamentals and the technicals, hopefully we'll get some reliable entry signals. But we may need to wait for these 2 items to line up. Okay, the first one I'm going to discuss today is Bannerman Resources. This is I wouldn't say prospective uranium company. It has uranium. They know that. They've got a pretty good idea of how much they've got, and they've got a plan to get to a mine in the not too distant future. We're sort of talking around about 2023 for first production. There are literally hundreds and not quite, but pretty close to thousands of stocks on the ASX that are quite literally kicking over rocks in a desert somewhere. These guys are well past that stage. So we are past finding a resource, drilling, finding. We are past scoping. We're at pre-feasibility for a mine. Current share price is 18.5 cents. Market capitalisation is 220 million. Enterprise value of 208 million. So that is just reflecting that there is a fair bit of cash in the business at this stage, or cash net of debt of about 12 million. The project is located in Namibia. Now, obviously in Australia, we have restrictions on uranium mining, not the case around the world. So if we're going to add a new mine to the universe of mines, then we'll have to go outside of Australia, but actually quite a stable environment in Namibia. So there's not a lot of sort of geopolitical risk associated with this particular jurisdiction. The project is called Etango. It's a broader, uranium deposit, but they're focusing on one area because they think it's the quickest way to get to production. And we're looking for an initial sort of production or projected production of 8 megatons per annum of throughput for 3.5 million pounds of U3O8. Mine life of approximately 14 years. The company is forecasting a 3.6-year payback and a net present value post-tax of 282 million, which if we go back a slide and compare it to the 208, gives us a little bit of upside. You might say, well, that's not a whole lot of upside. Well, there are a few factors there which could significantly improve that number. I mentioned at the beginning that it's important for us to at least have a path to not just revenues, but profits as well. So this is the path to production, at least for Bannerman Resources. We do have a pre-feasibility study due in mid-2021, a definitive feasibility study due in Q1 2022, construction of the mine from 2022, and then production expected in 2023. And based upon the reading I've done of the various company reports over an extended period of time, management appears quite adept at delivering on their goals. So I can't see any reason why they shouldn't meet that schedule. In terms of their operations, and normally in these webinars, my top 3 webinars, there's quite a long explanation of the fundamentals of a company, their revenues, their profits, projected earnings over time, growth rates, and the like, and a number of ratios. Well, we can't do that in today's webinar because those things don't exist. These companies aren't yet profitable. So when we look at companies that aren't profitable, for me, the most important thing is their cash burn. How much cash are they burning? And then we want to compare that to how much cash they have in the bank, because when they get close to running out of cash, it really only means one thing in this space, and that is a capital raising, where you'll potentially have to stump up some more of your own cash to support the operations of the business. And if you choose not to, you're going to get diluted. So preferably, we can avoid those situations. Well, the cash burn for Bannerman is approximately $2.2 million per annum. And that compares to the $13 million worth of cash they have in the bank. So that's over 6 years of current cash burn. Now, as we get closer to mining construction, obviously cash burn may well increase, but given how close we are to that occurring, we're only a couple of years away, there's a pretty good chance that they may not have to do another capital raising until cash flows commence. Not a whole lot of debt on the balance sheet at the moment, with only $600,000 of liabilities. In terms of the outlook, looking at the positives, they have environmental approvals, they've got community and government support, so fairly limited geopolitical risk in that regard. They do have the opportunity to become a globally significant uranium producer in an environment where uranium mines tend to be closing, not opening at the moment, and that's because prices are quite low. Attractive forecast cash flows and quite a short payback period. And the big upside, so we saw that the net present value that the company is expecting is about 282 million versus an enterprise value of 208. The upside, and I think what the market is expecting, is that much of their inferred resources are going to be converted to measured resources. And again, the company has a pretty good track record in this regard. The future uranium outlook does actually look quite bullish. I did say prices are depressed, and we'll have a look at the price of uranium in a second, but there have been some sort of mitigating factors there, including the Fukushima meltdown after the tsunami, and there was a significant backlog of uranium in the system to work through, and that backlog is basically worked through. As I said, a couple of mines have closed very recently. A number of significant producers have been taken out, and a couple of them on care and maintenance as well. So the future uranium market looks quite bullish. China is a significant emerging player in the nuclear energy space. Current risks include, well, the fact that uranium prices are quite weak and the company is forecasting a price by the time they get to production of $65 a pound, which is potentially optimistic, but I'll let you decide when we get to the chart. And then execution risk, which is that schedule not coming to fruition. Having a look at the chart and again, switching gears from what we think about the company to what the market thinks about the company, and the market looks pretty positive on the prospects for Bannerman going forward, and I think they are factoring in that there is potentially 2.5 times in inferred reserves that could be converted to measured reserves, therefore increasing mine life and potential present value of the operation, and also a pickup in uranium prices. So we do have a very well-established short-term uptrend, a very well-established long-term uptrend. We have made a very nice basing pattern through here, which has consolidated very well indeed the rally through here in December 2020. And anytime you have a big rally in price, generally that draws out supply. So a lot of holders who are potentially in around here, tipping out around here. Now, if the story isn't good, we will see a break through the bottom of this range and down we go again. And I'm sure you have literally seen that on your mining companies about 1,000, let's call it 1,000 million times, okay? When they don't break through the bottom of that range, and when they break through the top of that range, that is a sign that the demand, which caused the rise in the first place, was actually soaking up this supply. The supply has exhausted. We've just got a sufficient period of time for those sellers to be out. There's still latent demand in the system. We break through the top of that range and up we go. So I think quite prospective on the chart. There's nothing in the volume to suggest that we can't continue to move. A nice breakout there on volume, and then we should see volume dissipate after that. And if prices are heading up on that lower volume, then that is a good sign because it means that supply is significantly limited. Having a look at the uranium price. Now, this is the monthly chart here. It's looking at a really, really long-term view of uranium prices. This was the big boom back in sort of the late 2000s, pre-GFC. Obviously, the GFC happened, and then down we go again. We are seeing, a little bit of a base pattern here. So I think we have made a low, famous last words, but this popped through here, and then we have had a pullback from that, and we are seeing some demand come back in. So, look, I wouldn't say it's necessarily a screaming buy, but it certainly looks like we have made a significant swing low in prices. And Bannerman is highly leveraged to the price of uranium. Okay, next one we're going to look at today is Houston. We have quite an original, funky sort of name because they're in a very cutting-edge, funky, tomorrow-focused industry, which is augmented intelligence. So there's artificial intelligence and augmented intelligence, which where artificial intelligence is ultimately trying to replace the human. Augmented intelligence is trying to use data analysis, so analysis of large data samples to support humans within a business. So we are obviously information technology, software. Current share price is about 10 cents. And we are really talking micro capitalisation here at 31 million. Enterprise value is currently 29 million, which indicates that cash net of debt is about 2 million at the moment. Their main business, they have a number of proprietary software applications that analyse large data samples. And as I suggested before, we are using those data samples to support human decisions. Predictions, forecasts, risk models based upon their customers' data. And they have a number of customers, many of which are on screen, and a wide range of industries that they support. In terms of their major customer, that would be the Australian Department of Defence. It is their biggest client and recently had their contract extended. No specifics on what they do. For the Department of Defence, we know why that is probably the case. Top secret. For Wipro, however, they've recently just signed an agreement there where Wipro, which is a major IT services company, global IT services company, would distribute some of their AI technology to Wipro clients. That is a significant and important deal. And they have also a deal with Accenture, a similar one there, which is a reseller agreement. Accenture, just a major sort of business services and technology company as well to as I said, resell those products. But, in both cases, these last 2 points are relevant, increased visibility of the company's products and adds significant scalability to the business. They also do a number of credit risk assessment solutions, so basically predicting whether an individual is likely to repay a loan that's currently used by Marketland, assessment validation as well, so assessing the prospectivity of an acquisition for a business. amongst a number of other applications that they have. In terms of their financials, this is the only one out of the three that we'll discuss today that actually has revenues at the moment. So when you go to their statement of cash flows, at the top line where it says, cash in, there's a tick in that box. Revenues for H1 FY21 were 501,000. That compares nicely, obviously, to the corresponding period, which was only 209,000. So there is some growth in the business. Look, it did flatten out from H2 FY20 to H1 FY21. So that's something we'll just have to monitor when we get the next set of results in June, July. They are still a loss-making operation, but that loss is shrinking. You can see there 1.1 million versus the 1.9 million run rate. Cash burn, that's the all-important one for these small companies. We're looking at about a 1.2 million per annum cash burn with about 2.8 million in cash in the bank and $500,000 worth of debt. So, really a couple of years to get to the point where they can erase that cash burn, probably more if trends continue at this stage and they continue to get traction on the sales side. In terms of the outlook, key positives, upside through YPro and etc. partnerships. They do have a very broad product suite, so it's not a one-trick pony, and they do service a diverse range of sectors. That's important. They did say a number of times in their half-yearly and quarterly updates that COVID has negatively impacted them. So obviously, as that situation backs out, there's potentially also some upside there. It's only a small jump, really, to get them to cash flow positive. They'd only have to increase their revenue streams on their current run rate, and they're going to get very, very close to do that. We're talking, potentially between 12 and 24 months to get cash flow positive. And generally, when stocks do that, they do get a big market re-rating. Key risks include just that cash burn versus the capital raising. And look, let's face it, they are a small player in a big space. Looking at the technicals, so fundamentals look prospective. We've got some revenues. Revenues are growing. We've got a path to becoming cash flow positive and potentially profitable. A diverse range of products in a diverse range of sectors. So very interesting. What does the market think about the stock that we're analysing? Well, the market appears to like it. We do have well-established short-term uptrend. We've got these nice high peaks and high troughs. The candles, let's say predominantly white, and some good solid candles through here. The negative ones are fairly sketchy, and then we've got some good solid ones through here. A nice hold of this support level at around 9 cents and a solid bounce off it yesterday. Okay. The reason why we don't have more data, if you look at your chart, you might see that there is more data back this way, but it was a different company, completely different company back there, and we had what we call a backdoor listing where they vended new assets into the business, and that happened in the middle of last year. So this is the relevant data, and therefore we don't yet have a long-term uptrend at this stage to assess, but the short-term trend looks very strong. Okay, third and final stock for today is Tombador Iron, ticker code TI1. This is as the name suggests, an iron ore mining stock, but it's not exploring. It's not even pre-feasibility. These guys should be in production very, very soon, hopefully by the second half of this year. Current market capitalisation is 100 million, plenty of cash in the bank, you can see there, compared to the debt. So the enterprise value is 82 million. And quite interesting that about half the company is actually held by the major shareholders. So it's actually quite tightly held as well. So, indicates more limited supply for the shares potentially, and if there's significant demand, prices can move quickly to the upside. Okay, so their business is in Brazil, and we know obviously Australia is the number one producer of iron ore in the world. Brazil is number 2, so there's plenty of experience, plenty of expertise in that country to get this job done. We're in Bahia, which is in northeast Brazil. It is a mining-friendly province, particularly for iron ore, and that just means there's plenty of local expertise that the company can draw upon. Mine site construction is complete. Now that's a really nice phrase, isn't it, compared to the Bannerman one, which we're potentially going to start construction in 2023. Even better, crushing and screening plant is commissioned. That means it is ready to take ore. Trucking and port contracts have been signed to get from here all the way to here. Port contracts have been signed as well. They have commenced pre-stripping of the overburden, in advance of getting started on the mining. They have the mining license obtained and they're just waiting for their environmental license before they can really get going. They are on track to commence production in the June quarter of 2021. So that is, basically now, isn't it? Binding offtake agreement for their production. So even better. I mean, it's just going tick, 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 tick. So what they do produce has already been taken by Trafigura there for 100% of production. Okay, the resource, 10 million tonnes combined JORC mineral resource. So rather than, we talked about Bannerman's inferred and measured resources, these are measured resources, so we know they're in the ground. We're looking at 8 million tonnes of high-grade iron, and it's hematite, not magnetite. So this is the type of iron ore that's preferred by refiners because it's more cost-efficient to refine. I'll give you an example. Fortescue, for example, has the magnetite version. Very, very high grade, so it will attract a premium. So the standard grading is 62%. It's a very low cost operation. It's an open cut mine, so you literally just dig it out, you'll drive it down the hill and then take it to the port. Exploration and infill drilling continues with updates to the resource reserves pending. So that reserve could get even better. Here's the catch. So everything sounds really good up to this point, doesn't it? It's just run out and buy this and don't ask any further questions. But I have looked and I can't find any information on what the production schedule is going to be, which is curious given that it's supposed to be starting very, very soon. So that's a question mark, and this is the nature of this beast, right? If you're buying this at 10 cents with a question mark, you're doing it eyes wide open and you're expecting that those details are going to be forthcoming from the company. I'm unable to value this business without expected cash flows and without that information that the company has provided or has not provided. So, I have to make some assumptions if I'm trying to get a valuation out of this. And I do assume that given the metrics that we do know, that it will be cash flow positive shortly after mining commences. Very low capex, high grade hematite deposit. These are all massive ticks. Currently, 24 million in the bank provides more than ample funding until production commences and cash flows come in. They're basically overcapitalised, if anything. So I did do some back of the envelope and very conservative present value calculations for this one, comparable to other small iron ore miners and what they've got on the ground, how long it should take to get it out, and then using, roughly sort of $150 to $160 a tonne for iron ore now, and then really backing that down to, I think it was about $60 or $70 a tonne for years 6, 7 and 8. So quite conservative, and I came up with a net present value of about 350 million, and that compares quite favourably to the enterprise value of about 82 million. So potentially, give or take sort of 3 to 4 times upside potentially just on that. Okay, key risks. Ongoing COVID situation in Brazil. Not a lot of talk from the company on the impact of that, so I would have to assume that given they have progressed so well up to this point, that's been fairly limited, but we don't know the future there. And an iron ore price correction. Having said that, I did use very conservative estimates in my assumptions here. Otherwise, looks highly prospective with all the development done, offtake agreements in place and potential for resource upgrades as well to extend the mine life and further increase this valuation here. Okay, so we've again at this point where the fundamentals on what we can see look fantastic. Do we run out and buy it? Well, let's determine whether the market feels the same way we do. Once again, fairly new listing for what the enterprise is now. So we don't have a long-term trend, but we do have a short-term trend, and it looks pretty good. It's quite well established. We have had this significant run-up through here. We've made a nice base pattern through here, and we're pushing back towards the top end of the range. It's no surprise that we saw a little bit of selling at this previous point of supply from the past. There are people who got in at this level, and for this period of time, they have done only one thing, and that is wish that they had not bought at that level, especially when it got down to 7 cents. So there are going to be a few people that sort of tip out here as a result of that. And the question then is, look, how much demand is in the system to absorb that hopefully short-term supply? And if we do get some nice price action signals in here, so we might be talking candles that look like this or like this, so white candles, then that would indicate to us that demand, that latent demand, is still in the system. Certainly, if we can break through 11.5, then that would indicate, or I guess imply, that we could see higher prices. In the meantime, we will be supported by the short-term dynamic support zone, which is probably coming in around that sort of 9 to 9.5% level. And if you saw this sort of signal in there, then I would be more than happy to buy it on the basis of the short-term trend, and that demand is probably coming back in. Okay, thanks for joining me today. You can catch all of our other market news updates in our market news section of the website. You can follow me or the Think Market handles on Twitter if you like. And we've always got these upcoming webinars, Ask the Experts, where you get to bring your portfolio to the table. That'll be happening this time next Tuesday, where I'll be online and you can ask me anything and I'll do a quick fundamental and technical analysis for you. The week after that, we will have a educational webinar on how to use price action to spot trading signals, and then we'll go to the next of our top threes, which is top 3 ASX mining stocks, and the goal there is to do 1 small cap, 1 mid cap, and 1 of the majors. The disclaimer before I leave you says that everything we've discussed today is general in nature. It's very important that you do your own research, understand the benefits, the risks of each of the opportunities that we've discussed. At the end of the day, you are responsible for your own decision-making process. We are a regulated broker. We do have some products that could see you lose more than your deposits. Please read this disclaimer carefully. If you have any questions at all, please give us a call. It has been a pleasure chatting with you today. All the best for your trading until we catch up again. Bye-bye for now.